Welcome to the Evergreen Real Estate Podcast. This is episode number 3. I'm here with my co-host, my uncle, my friend, my mentor. Let me get him on screen here. The guy showing his guns. Come on.
Let's go.
That Beasley strength.
I'm still a beast.
Anyway, so we were just on the phone on the Zoom call with Kartheek Mulpuri. He is a Stanford-trained industrial engineer, which is basically a degree in applied math. This guy is super, super smart. I gotta be honest, I had to clarify something. He started rattling off some stuff and I'm like, what is that? I don't know what you're talking about at all right now. But he also spent time as a venture capitalist, also an investment banker. He worked in tech and continues to work with tech startups, while also now balancing a career in multifamily real estate investing. The guy's a beast.
Yeah, you know what's funny? The old saying, you know, if you're the smartest guy in the room, you're in the wrong room. Well, I think we were both in the right room today. there was a couple moments where like 35% of the words that he said went straight over my head. So
Joke's on you, Kartheek.
The dude's a beast, but honestly, there was a couple things that stood out. Number one was his answer to our final question of the podcast. If he was starting over, what's one thing he wished he would have known?
Yeah.
And so it's a very profound answer, yet totally applicable, and it's digestible to the average brain, which was cool. And then the fact that the guy has his hands in, you know, real estate is still a side hustle. He's a GP for 500 plus units, and it's still a side hustle. So it's just remarkable individual.
Yeah, and also too, he was talking about during COVID, he had a lot of extra time, and he wasn't one of those guys who was just sitting on his hands. We're asking him what he did during that season and what some of those things were, and those things are the things that put him in position to be able to do what he's doing now. So listen out for that. Without further ado, let's welcome Kartheek Mulpuri.
What's up, guys? I'm glad to have Kartheek Mulpuri on the show here today. Kartheek is the managing partner of Sixth Sense Equity. He's a general partner in 3 multifamily properties, totaling 114 units in Virginia and Tennessee, as well as 4 mobile home parks across the Southeast for a total of 528 lots. The firm also holds limited partner stakes in an institutional multifamily asset in the Dallas area and an industrial asset focused on the cannabis space in Michigan, which actually might be fun to dive into. The firm's core focus is value add Class B and Class C properties in Virginia and in the Carolinas. Kartheek has been a finance and operations executive at technology-focused companies ranging from early stage to public. He was previously a venture capitalist and investment banker over his career. Kartheek has worked on 25 plus capital raising transactions totaling nearly $2 billion in aggregate deal volume. Dude, welcome to the show, man. I'm excited to have you.
Yeah, pumped to be on. Excited to dive in with you guys.
Kartheek, I know you mentioned when we were just talking a little bit offline, you mentioned that you had a background in venture as a venture capitalist. Just giving us an idea of kind of where you got started in your career before real estate, and then talk about how you transitioned into real estate.
Yeah, so my very first job out of college was investment banking. I was in the Bay Area for a couple of years, and I had the chance to work with a number of companies in the software, semiconductors, and communication spaces on important events that were on their horizon. So mainly sell side M&A, so preparing them to sell their businesses.
I don't know what that is. You got to educate me on that, man. I'm not going to pretend I do. What is that? What is that?
Yeah, so diving into that, what sell side M&A is you're serving as a company's advisor, essentially a broker, to help them sell the company, right? And it's not that dissimilar from a real estate sale process where you can kind of quote unquote market it off market, right? Which means, you know, say a group approaches the company as a buyer, then they can get a look at the company before it hits the market and preempt a formal process. But then what you tend to see, as you see with real estate, is an auction process, and investment bankers help to lead that on behalf of their clients. So got to work on that. Got to work on some IPOs and secondary financings as well. You know, the investment bank I was a part of would jump on and help out on that front. So it was a cool experience. And so from there, after spending a couple of years in that role, I went to venture capital. So coming from a tech background in my investment banking career, venture capital is a natural fit. And, during my time in venture capital, we had the opportunity to invest in a number of early stage and mid stage software companies across a bunch of different verticals. So financial technology, infrastructure software, application software, advertising technology. It was a fun time, because the thing is, you navigate the deal, right? And you get through the deal, but then you've got to also help, companies, get to the targets that they laid out in their investor decks, right? And look, oftentimes there's stretch cases, but that's where, I think value add investors come in. They let founders and their teams run their companies, but provide any advice or insight to help them unblock any obstacles that come on their way. And then from there, I've spent most of my career actually as a finance, operations, and strategy executive at a number of different technology companies, early stage, mid stage, and late stage. I've had the chance to serve as the de facto COO and CFO of an early stage company, helped to lead the sale process of that to a mid stage company, where I was responsible for international and helped to launch operations in Dubai and Japan. That was a fun career experience. And then late stage as well, coming on board to help what was at the time a pre-IPO company fine tune things when it came to their strategy and operations, so that they could unlock efficiencies in the business. And I'll actually be joining a late stage company next week for a new W2. So I'm excited about that.
Kartheek, how old are you? If you don't mind me asking, that is a ton of stuff to be doing how old are you?
I'm 33. I'm not as young as
No, 33 is young. I'm 31, I'll be 32. And I'm like, man, I haven't even come close to doing all this stuff, and it's so cool that you've been able to do all these different things. Question for you, Kartheek. So getting into, if you're in the tech space, it can be super lucrative, but it can also be super risky. You're at a startup, at a tech company, and there are no assets, there's no liquidity. So if it works out, it works out, and you're doing really well. And if it doesn't work out, you're not doing super well. How did you get yourself into a position with those tech companies to be successful? And it seems like, based on what you're saying, seems like it's on a repeat basis, where you go into one company either in the beginning or mid or the final stages of that company, and you seem like you're doing pretty well. How did you approach, just in the tech space, what did you do differently that other people weren't doing?
This is almost a segue into the, how did you make your way to real estate question?
Well, this is a real estate podcast, so yeah. I'm trying to make transitions.
No. I say that, right? Because to your point, tech is very binary, right? Oftentimes you either hit it big, like a lot of the companies that IPO'd or sold over the past couple of years, at least prior to their stock prices dropping since November. Or more often than not, the equities becomes the donut, right? It's a zero. And so as I was going through my 20s, I was fine taking that sort of risk, and I'm still fine with taking that sort of risk as an employee joining these startups. But then as I got into my late 20s, I also wanted to build a steady source of income from other means, and real estate is exactly that, right? So with tech, you hear stories of employees, 10xing, 100xing, sometimes 1000xing, right? Their equity grants. That's not going to happen in real estate, right? But real estate feels like a solid path to a 2x, and then if you really stretch it, sometimes a 3x, right?
I want to stop you there. So you said that you got involved with these companies in this tech space in your 20s, and you said that you were comfortable taking those risks at that time. Now, did you have any other things going on in your life where, like, were you married, have any kids or anything like that? Were you single? Kind of what did your lifestyle look like at that point in your life?
Yeah, I was single at the time. And,
So that's what I want to say. When you're in your 20s and you're single and you can kill it, That's the time to do it. When you're in your 20s and you don't have the family and the kids,
Yep.
and you're in a position where you want to work on your career. Me personally, Kartheek, I got married at 22 and started having kids at 23, and I've never stopped. I have 4 kids now, and I'm in my 30s, and I'm thinking, man, how do I start to develop my portfolio now, starting really at 30 or 31? And there's not an ounce of regret in the decisions that we've made as a family. I love my kids and I love the decisions that I've made. However, if you were in that position and you want to start establishing yourself early on, like, get your head screwed on straight when you're in your 20s and you're single. Because if you can figure this thing out, it makes it so much easier. David Green from Bigger Pockets, I was listening to one of his shows, and he was saying, he's like, if you just work hard in your 20s, he's like, you will, for the rest of your life, it will be paying dividends. So I just wanted to stop you there and just say, listen, if you're going to go into something that's kind of risky, you could, go big or go home. Do it in your 20s when you don't have as much riding on you. If you fail or whatever, you can pretty easily kind of pick yourself up. You could live in a small studio apartment and get on with the next career path. So I just wanted to make that quick little point there.
And what I'll say about that is, even if your venture or endeavor fails in your 20s, like what you go through in terms of learning, that pays off dividends long term as well, right? And so, the early stage or mid stage companies that you can be a part of, right? Especially an early stage company, you get to wear a lot of hats, so you get to learn about a bunch of different areas. And whether that venture goes well or not, right, the skills that you've learned, they don't necessarily go away. You can continue building off of those skills, and you can use it, right, if you're making a transition between the industries as well. So
it's just like anything. The skills, like the investments, the skills also compound over time. You learn, you stack one skill and one experience on the other. And then over time, those skills and that experience and those networks, it's this virtuous cycle over time. But all I'm saying is, if you start early, you're going to do a heck of a lot better down the road.
I want to hear the transition into real estate, man. So obviously this is an easy transition in terms of your background prepared you for exactly what you do now. But like, when was your first deal? How did you get into your first real estate deal?
Yeah, it's funny that you guys lined up family responsibilities with taking risks. And so I think my very first deal, right, was a passive investment deal, and we did that deal a couple months after I got married, right? So it's kind of, you get married and then you make your way into real estate to start building out the portfolio. So that was, I think, back in 2018. And that one's actually selling now. So it's cool to see that one go full cycle over the past few years. So that was my first deal. It was still living in New York City, or more Jersey City at the time, which I still consider to be the 6th borough of New York. So I count it as New York City. Yeah. So that was the first deal that we got into. And during COVID, we moved back to Northern Virginia. And so, making that way back to Northern Virginia opened up a couple things, right? One was time, right? I think a lot of people had time during COVID to learn new things, to work on projects, so on and so on. And so I invested my time to start learning about, multifamily as an operator, right? As an active investor. I learned some as a passive investor and from reading books, but I wanted to put that theoretical learning into action. And so I joined a mentorship program, and John, you're part of the same one, and I'm sure you've gotten value out of that one as well. But then the move back to Northern Virginia also meant that I was closer to cash flowing markets. Where doing multifamily deals, it became more of a reality, right? So I think those two things coupled together, kind of set the stage for me to get more active. And then I did my first deal as an active investor, which is a syndication, and kind of co-lead sponsor with my partner who's down the Hampton Roads. We closed that in June of 2021. And that was a deal that we first looked at in October of 2020. So think about that, October to June. It took 9 months to get it done. And that was a sticky one, deep value add sort of Class C deal. And since then, we closed another 40 unit in Lynchburg, Virginia. That was in December. And we're currently working on a 66 unit in Lynchburg as well right now.
When Kartheek, when you were first getting started, and then Uncle Jonathan, you're next. I'm sorry. I have like a ton of questions. When you were first getting started, you mentioned, 2020, you were spending that extra time to get educated, learning how to be an operator, how to run a deal. What were you specifically doing in those early stages of your real estate career? What were the daily habits and activities that you were doing every single day that helped get you where you are today with your portfolio?
Yeah, I made a point to network as much as I could. And during COVID, a lot of folks were receptive to phone calls, right? I'm sure you guys had a ton of Zoom meetings and phone calls as get to know yous with other folks from the community and from other places. So that was one thing that I emphasized, and that's how I met my partner. So most of my partners, all my partners either are members of that community or I was introduced to by members of that community. And so building a team was an outcome of all that networking in 2020, and I still continue to network. Right, it's always great to meet new and emerging operators as well as established operators, right? Because you can pick their brains and learn a little bit, right? Whether it's a new market, technique, or something else. And then the other thing, right, was applying my underwriting skills from tech startups and applying those skills to multifamily, right? Figuring out how are these assets underwritten, what do the revenue and expense structures look like, where efficiencies typically found, and obviously practiced a ton early on before submitting an offer. But once I felt comfortable on that front, that's when we started submitting offers. And the thing that I think many newer folks listening to this podcast do, right, is they underwrite very conservatively to start with, right? Because you're kind of scared to screw up, miss out on this line or that line. But I think as you underwrite more and more, as you do deals, then you have a better sense of where you truly can push for efficiencies and where outcomes are we're likely. And so you kind of tighten your underwriting over time with more reps.
Yeah, absolutely love it. It's funny. We're doing a couple of smaller deals. I have one building in Williamsburg right now. It's a 15 unit. And when I bought it, I think we actually talked about it. When I bought it, rents were in, average rents. Most of them are studio efficiency units. Rents were $625 to $675, and there was not one report. Everything you looked at on CoStar told me that the comps after renovations were going to be in the 8s, and I'm leasing them up now regularly for $1,000 to $1,100. And there was nothing on any report that I could identify that would have told me that I could get it. I just knew that I could because I knew the area, and obviously being a broker down here and understanding market sentiment and demand was a big deal. But totally identify as you can underwrite it conservatively, but there is another level of feeling your way through a deal based on the experience that you have.
Yeah. And Johnny, you mentioned something there. So something else that I did during that time in 2020 was really study markets, right? Visit them, talk to locals there, whether they were owners, brokers, or others. And really get a sense of, if there was growth, where was the growth coming from? What did vacancy look like in the market? What did that supply demand look like, right, between new deliveries and growth coming to the market, so on and so on. And so you kind of alluded to that with Williamsburg, because you as a broker really understood that market much more so than the person in New York. No offense, Michael, looking at a
yes, no,
report.
Absolutely, yeah. In fact, if you look at the population growth, people are just it's insane, and it's New York City. New York City is a fading star. it's no longer going to be New York. It's not. It's done. Like it's going to be. It's it's not. I don't know what the next city is going to be, but one of these other southern cities is going to take its spot. Like it's not going to be New York. It's going to be somewhere down south. So when I'm talking to people somewhere, whether it's going to be south, just because it makes so much more sense from a financial standpoint. Think about, you don't have the even just like freezing pipes and all the things that you don't deal with that stuff in Arizona. You know what I mean? You deal with that stuff in New York. We're talking about laws and landlord and tenant laws. I mean, in New York City, I have my wife has a rich uncle, and he owns property in the city. He's always like belly aching about the mayor, and he's de Blasio's making it so hard to do this and that. And it's true, because he can't. If you fix up the unit, you can't raise rents. You can't do anything. Your hands are completely tied. So he's telling me, he's like, listen, I want to sell this building. I want to 1031 it into something else. So we're looking for a deal for him. But yeah, New York doesn't make any sense as a market. Invest down south.
I'm not, I don't envy those owners in New York and all the hoops they have to navigate, for sure.
Yeah, it's ridiculous.
I'd be curious to hear a little bit more about how your team came together, and selfishly, just out of like morbid curiosity, when you're, making these calls and connecting with people during COVID, you obviously joined a group to get some education and expand your network. But how did you guys kind of come together as a team and sort of identify, strengths and weaknesses, because every team needs a point guard and a center and a power forward and that sort of thing. Mm-hmm. How did you guys kind of put those pieces of the puzzle together?
Yeah, so for me, it was kind of assessing like, what am I good at, and where are the gaps? And I felt pretty comfortable that I'd be the point person on underwriting, and once I learned it, kind of leading the transaction piece of it as well. As well as the investor relations piece for the syndication. Because, for myself, the companies that I've worked at, I've helped to raise the capital for those companies, but then afterward, I've been in that de facto investor relations role, right? Providing them, constant updates along the way on, how the company is progressing and so on and so on. So kind of bring that skill set with me to real estate was, what I felt comfortable contributing. Now, the gaps were, capital, and then asset management and construction, right? Because this was an entirely new space for me, and especially construction, right? I wouldn't have known where to start. And so I, looked to fill those gaps. And so I was introduced to my fellow lead partner, Keith, who's down by you in the Hampton Roads. I want to say the summer of 2020. I was introduced to him by a fellow member of the community that we're a part of. And for him, he had over 50 doors, I believe, all multifamily before he and I met. And he'd been a real estate investor for 15 or 20 years, and he'd graduated from single family to multifamily, like a lot of folks who are in our space. But I think his gap was capital and going after larger deals. And so kind of his goals plus my goals plus our shared visions and shared values made it a good fit to start working together. And so we started looking at deals together, I want to say toward the end of the summer of 2020. And we put a few offers in. Those some were close, others didn't go anywhere. But then the 42 unit, right, the deal that we took a look at in October, that was the first one that did go somewhere. And then for capital, I think actually the very first member that I ever networked with in that group, was the key person on that front. And what that person brought with him, this is Nick DeLeon, what that person brought with him was, I want to say 10 to 15 years of institutional experience, right? And that's super valuable for folks like us, folks that are making their entryway into multifamily, right? Because if the institutions oftentimes have some of the best systems and processes to use, right? And so having him as a resource to pick his brain on those systems and processes, something that both Keith and I have found to be quite helpful.
wanted to backtrack, actually, if you're cool with it. You kind of brushed over the two things that you were working on during COVID: networking, number one, and then number two, studying markets. And studying markets is, I mean, that's a whole black hole of, you can get in, you can get involved and use all these different services, CoStar and what have you, all the Google stuff and data, city data and all this. What is your system? What is your method, or kind of your way of looking at a market? Let's say that there's a sub-market somewhere in Texas or something like that. What is kind of your go-to in terms of what you look at to determine its viability as an investment market?
Yeah, so let me start with this. When I first got, started looking at markets, I was looking at markets all over the Southeast, and that was pretty inefficient and ineffective. I didn't, I would network with brokers, network with folks, but I wasn't really getting anywhere, right? Because I was looking at like 4 or 5 markets at the same time, and none of these markets were close to me. And so when I met Keith, that's when I settled on just focusing on Virginia, maybe North Carolina to start with, because these markets, right? These markets or sub-markets weren't driving distance to me. And the other thing on top of that is, with Virginia, not only are Keith and I, local to the markets within the state that we invest in, but there are just built-in competitive advantages of being of investing in the state, right? And a good example of that is, for smaller deals, especially community banks, right? There are a lot of community banks that won't work without estate investors. And so, that gives you a built-in advantage, because sometimes it's community banks that can, be the most flexible with you in terms of terms. So I'll start with that philosophically, but then to answer your question, what do I look for? I look for, population growth first and foremost, right? Because for real estate to have value, it's got to have people, right? And ideally the populations of the markets that you're investing in are rising, right? You're looking for median income growth, and especially with inflation, that's all the more important, because you want to make sure that rents or target rents can actually be paid by the tenants who are investing or who are occupying the spaces in your apartment units in that given market, right? So, a rule of thumb, right, that you guys are aware of probably is, 3 to 1 income to rent ratio. And ideally, you want to be a good bit higher than that, right? Because if you're a good bit higher than that, then tenants are better able to absorb rent increases.
Do you have any minimums in terms of what you like to see for median income, like what the median income level is, or what the growth is over the last 10 years or whatever?
Yeah, so for median household income, I want to see that typically at least 50K in a market. And, I want to see that, income to rent ratio on a market basis at least 4 to 1.
Okay. Gotcha.
Right, because that gives me a better sense of, like, again, right, are tenants better able to absorb increases to rent? And then on top of that, I'd look at the employers that are in a given market. So I look for a few things: diversification of industry. I want to make sure that oftentimes, one employer is not, providing everyone jobs in the market as a whole, right? Because as you guys know, if that employer leaves, then you're exactly.
If it's a coal mining town, if it's a gold mining town, if it's an oil rig, that's it. Once the oil dries up, that's it.
Have you ever had concerns, Kartheek, about the military concentration here? I mean, obviously it's Uncle Sam and it's the government, but I'm pretty sure it's like 30 to 35% of like all of the economics of Hampton Roads are either military or military contract services related. So I'm actually kind of curious your thoughts specific to Hampton Roads.
Yeah, no, it's a great question, right? Because that is a risk that comes up for a lot of markets, right? So Jacksonville, North Carolina is another one, right? With Fort Bragg, I believe. And there are a number of these towns and cities across the country where military concentration is a risk. The reason why I'm comfortable with the Hampton Roads as a market is because the Hampton Roads is just so fundamentally important to our military as a location that, even if there is some downsizing that might happen, I don't see the Navy and the other branches that are already there leaving the Hampton Roads, given the importance of the location, right? If it's a smaller town in Kansas or elsewhere, and you've got one base there, then yeah, that is a real risk. But no, Jonathan, to your point, I just think that Hampton Roads is just too important to our military as a whole for folks to
That's kind of always been my take on it too. I mean, Norfolk is a strategic point. Obviously, it's the largest naval installation in the world, and you have the CIA headquarters at Langley. So yeah, I agree, and it's actually encouraging that your thoughts are sort of along the train as mine.
I mean, keep this in mind too. So, Virginia, right, obviously borders DC. And so a lot of the politicians and lobbyists and influencers, they live in Virginia. So there's some kind of built-in interest to make sure that, these bases do stay in Virginia, given the influence that, local politicians in Virginia and lobbyists and others can have.
Yeah. Did I understand that real estate is still a side hustle for you? Like, did I catch that?
Yeah, right. You still have a W-2.
Yes, I'm starting a new W-2, but I spend a ton of time focused on real estate. I'm always underwriting new deals, asset managing, these days, existing deals, and, investing and building out systems, building out my team. So I spend all my free time, nearly all my free time, focused on, commercial real estate.
Let me ask you this. This is a little bit more like existential, but I'm sure that if you wanted, you could probably figure out a way in the next couple of years to not work and you'd be able to just live off the passive investments. What is it that motivates you to keep going, to keep pushing, to keep growing, to keep doing it? For people who are either get sick of it or get tired or whatever, decide that they don't want to, or it's not for me or whatever. What's the thing that keeps you going?
Yeah, for me, it's the fact that I really, really love this. Love this space, and
yeah,
I love the whole process, right? It's really fun. Looking for the next deal. It's really fun when you're underwriting a deal, trying to identify the potential efficiencies that you can find, right? It's kind of like solving a puzzle, almost. Structuring the deal, and kind of optimizing for it on the front end. That is all super fun, and then executing on it under the timeline. Yeah, it is super stressful, but it is. That is fun as well. And then the asset management, right? Executing on, your business plan and kind of putting that into motion and watching theory become reality, right? That's
all that math that you learned about and practiced in college in your early, like now it's actually happening. It's coming to fruition. And I love that. It's you found your niche. And that's why I wanted to ask, because you found something that you're good at, that you love doing, that you're compensated well for. And it's not something that feels like work. I'm sure, like you said, during a sale or a refi or an acquisition, it's going to be stressful. It's going to be work, but this is what you enjoy doing. You enjoy running the numbers. You enjoy seeing, hey, how could this work? Kind of putting that Rubik's Cube together. And then when it actually comes to fruition, it's really satisfying. I think that's amazing to have found your niche, because a lot of people don't get there. They're just working a regular job or they're doing whatever, and they don't really do what it takes to find that niche. And it seems like at an early age, you kind of knew where you wanted to be and where you wanted to go.
Yeah, Michael, you had asked an existential question regarding real estate. I'm actually curious, what is driving you to stick with your W-2? Is it in the same vein, like you're doing something that you love, or is there a sort of a greater financial plan in motion here? Just because similar to Michael, I would imagine if you wanted to go full-time into real estate at some point, you could or could plan to. So just kind of curious, what's the rhythm, what's the purpose behind the rhythm of keeping the real estate totally as a side hustle at the moment?
Yeah, so for me, I do enjoy tech at the same time. The process of building tech companies. I mean, if we're being frank, in my opinion, there is no company with a better business model than an enterprise software company. Because for enterprise software companies, most of your revenue is recurring revenue. The gross margins for a good enterprise software company are north of 90%. And yeah, I mean, you're spending a lot on sales and marketing. And
that's true. It's inherent with the risk profile. Like if you do it well and you're good at it, because you have such low overhead and because of the potential for growth, I never actually thought. I mean, me personally, I'm like, oh my gosh, like I'm not tech at all. You know, I always think of it in terms of the risk, but on your end, you're like, hey, but if you do it well and you get involved and it's subscription based or whatever, it's recurring revenue. Makes a lot of sense for sure.
Yeah, so you basically stack revenue on top of existing revenue, and if your product is good, then you'll be able to also upsell your customers to buy more and more in terms of new module or expand seats on your platform, right? And it is fun to build these sorts of businesses because you kind of you see the results stack on top of each other and compound. So I do enjoy that piece as well. Which is why I'm joining this new company as a W-2 because I'll have a key role in influencing some of those outcomes.
Do you have long-term plans to stay in that specific company role?
So I think there is going to be a time where I just do pivot, fully to real estate, but I don't think that time's yet, right? So I'm gonna keep enjoying both industries. There's a lot to love about both industries, and again, right, I think having my feet in both industries, it helps me to be better in the other space because there are things from real estate that I can take to my tech job, and there are things from tech that I can take to real estate. So I think, yeah, I mean, those synergies, right? I've seen them play out, and I think they're going to continue to play out.
I love that. All right. Well, we have this last section here. It's called the Let's Get Personal section. We ask everyone these 4 questions here just to get a little bit more into kind of just more basic sort of casual sort of stuff. Real quick, what is your favorite food? If you had your choice, what's your favorite food?
My favorite food, at least when I was growing up, it was, do you guys remember mall style bourbon chicken?
Yeah, dude.
I love bourbon chicken.
There's always like a Sbarro, a Burger King, and then the mall style bourbon chicken.
And they're hitting it too. They're like, "You want some chicken? You want some chicken? You want some chicken?" They're always like,
"Yes, yes."
Like
you can eat a full meal just going around the food court picking up.
Dude,
samples.
It's a thing of the past now. I don't even think they do that anymore. Maybe they do. I haven't really been to the mall, but I haven't seen bourbon chicken since COVID. Like it's a thing of the past. If you weren't in tech and real estate, it's funny. Normally people are in one thing, and now I have to ask you, if you weren't in these 2 spaces, what would you be doing otherwise?
What would I be if I'm in these 2 spaces? What would I be doing otherwise? Like in terms of like another industry,
another career, another industry, or what do you like to do if you weren't doing this right now?
Well, my dream job growing up was to, be an NFL general manager, but and I don't think that's happening, guys.
You could. I feel like you could. I mean, talking to you, I think you just kind of like waltz in there and be like, "Hey, listen, I have all this operations experience, and I'm good. I've ran these companies. I think you probably could still do that if you want." All right, where are you in the next 3 years? I mean, you're taking this new position, so we can probably gauge. But where are you going in the next 3 years? Where's the next 3 years headed for you?
Yeah, so for me, with the W-2, I want to jump in, make an impact, help this company achieve the goals that it set out for itself. So that's one piece of it. And then on the real estate side, continue to build out the portfolio. And being able to shift my strategy to the market at a given time, right? So I think when Jonathan read my bio, right, he mentioned value add Class B and Class C properties. Right. Now the challenge is, with the labor shortage and with supply chain issues, there are real delays in implementing value add strategies, right? Doing rehabs and I think I mentioned to you guys before we jumped on that the 66 unit that we're in the process of acquiring right now, it's a Class A, right? Without a lot of CapEx needs. But what pumps us up about the asset is that there are a lot of operational inefficiencies that we can solve for, right? And so that's, one pivot that we've made. I mean, obviously we'll keep looking at Class B and Class C deals too, but they really have to pencil for us to move on those.
It makes more sense sometimes to move to just a Class A property because you have so fewer headaches. You don't have the issues with supply chains as much. And there's not that, like, because everything's inflated, there's not that huge discrepancy between a C and an A class property. Is that kind of where you're going with that? The same sort of thing?
That's another point. And then a third point too is that, when you take a look at the income to rent ratios of the folks living in A units, they're going to be higher than the folks living in B and C units.
Interesting.
So
yeah,
the ability to pass on rent increases to folks in Class A communities is higher. And I think the data has played out that way, where if you take a look at the data last year, I believe Class A's were the highest on average in terms of rent growth. We just, we're going through the lease audit right now in the 66 unit. And what I'm noticing is that half the tenants are at, 5, 6, 7x income to rent ratios, right? And so that makes us pretty fired up that,
right.
When we push rent increases to our tenants, that they're going to be able to absorb those.
That's amazing. That's good. I never actually thought about that, but that makes a lot of sense. If you're buying,
could we take just a couple minutes and dive?
Yeah, that's totally cool. Yeah. I think it's great.
So, okay, so it's Class A, it's 66 units. Like, what's your hold and reposition timeline going to be?
Yeah, so this is a different sort of deal. This is a loan assumption deal. So we're buying from an owner that bought in late 2019. And that owner is looking to sell now. And when he bought with agency debt. And so if he were to sell now, he'd basically incur, as we understand it, a 7-figure prepayment penalty. And so what we're doing here is we're taking over his loan with agency. And as a result, we think that we're getting it at $1 million discount relative to in the market if we're to buy it free and clear. And so our play here is to basically go in with low leverage. So we're projecting a 66 LTV, which is a lot lower than what folks typically do. So that's one piece of it. And the numbers still, pencil really well despite the low leverage. We're projecting a 17-ish IRR on it, north of a 7% cash on cash return on the asset. And the play here, right, is to implement our business plan, but at the same time, work down this yield maintenance penalty to a much more manageable number. So we're projecting that in 5 years, we can work it down from 7 figures today to more roughly $300,000.
That's just,
right?
When you say work it down, you're talking about simply just waiting it out, like letting time.
Waiting it out.
Okay.
Yeah. Kind of, that built-in equity basis that we're getting at acquisition, kind of achieving that, right? The longer that we hold the asset.
Got it.
And then the other piece is the location. It's in a downtown area of the tertiary market, and that downtown area has really been booming the past 10 to 15 years. And so that's where that's a submarket where vacancy is extremely low, where the rents are the highest. And so being a part of that submarket's growth is another piece of our strategy.
That's killer. Talk to me about some of the inefficiencies. Where do you see you guys being able to kind of, create more efficiency in the property to get better NOI?
Yeah, so one thing is on the rent side, typically, I think one thing that we're taught, right, is to bill back tenants for utilities and some of that stuff. What we're noticing with this asset is that as of now, the current owner is giving away utilities, direct TV, internet, parking, valet trash.
Well, and you get a parking pass, and you get direct TV, and you.
He's operating it like it's a furnished rental.
Exactly. Right.
I mean, there are some units that are furnished rentals, and so Yeah, so billing tenants back for that is a piece of our revenue strategy. We're going to also bump up base rents incrementally, but then the expense side is what really fires us up about this deal. So I think as you guys are aware, direct TV is dying, right? Fewer and fewer
Yeah.
folks are watching it given the rise of streaming.
Right.
I mean, let's ignore Netflix's earnings for a second.
Yeah. Right. That's
But
a blip.
we know
That's
that.
a blip. Yeah.
Yeah, we know that streaming's growing, and so we're
Yeah.
gonna kill the direct TV portion of the contract. That's going to save us close to $30,000 a year, which is significant. Comes out to roughly $400-$500 a door, right? So that's going to be a major piece. We're going to look to save on insurance with this asset, with getting a better quote from another carrier, and then this is where it helps to be building scale in the market. We're going to split the headcount for this asset with our 40 unit. So as of now, this property has a full-time property manager. And so we're going to split that person's time with our 40 unit. And so the expenses are more in line for the property.
That's killer. What cap rate are you purchasing it at?
Yeah, so because of the built-in equity basis we're getting it for, it's something like a 5.5% cap rate. We think that if we were to buy this free and clear, that cap rate would be closer to 4.
Yeah, that's killer, man.
Yeah.
So your return on these efficiencies is amazing at a 4 cap.
Yeah.
That is awesome. Man, nice deal. I love it.
Yeah, and that's the funny thing too. And I love that you're looking at it as an financial operations guy. You see all this, operations inefficiency that you can go in and fix. Like a guy like me, I'm looking at the building. I'm like, oh, how can we increase rents, this and that. And you're like, well, if we just bring the operational expenses down so much, like there's your income right there. There's your bump. And there's a lot that you can do when you have that experience. I'm going to name this episode, I think, How to Compound Your Life, because I'm looking at your life and I'm looking at seriously, because you start off with just, starting off in tech and starting off doing kind of learning that whole side of thing and finance. And then each one of those skills build upon the other. And then you kind of just capped it off where you're like, yeah, I'm splitting the property manager between these two different buildings. And that's the compound effect of being in the same space, being in the same geographical locations. What I'm trying to say, because you have all your systems in place and already, now you're just building out that portfolio within the same area. And it's just growing. It's just compounding over time, and I love seeing that. And I kind of see that theme in your life here. And so I think that's what we'll end up naming it.
And you guys know it's hard to be a buyer in this market. And so you've got to find an edge, right? And one way to do it is by, having existing assets in a given area and then using those efficiencies to be able to, put a higher price up.
100%. Right now is the time to make deals. Finding deals is very difficult. So you have to make deals. Like even personally, we've transitioned a bunch of our stuff to furnished rentals and doing some Airbnb, just kind of being agile with the market, because it's not an easy time to be a buyer, but there's always a deal, there's always something.
Like the travel nurse. I know my uncle, Jonathan, he's been focusing on this kind of short-term rental model, with traveling nurses. And I work as an assistant nurse manager. That's my W-2 job. And while we've had a lot of travel nurses with COVID and starting to kind of wane a little bit, but during that time, being positioned such that you can capitalize on a market change like that was really smart. And I thought that I was like, wow, that's amazing. And it's like, these people have great income. They have solid jobs. They're clean. They take good care of the property. They pay up front. It's all these things, but you have to have an ear to the ground to know what's going on in the market. You can't just be the one trick pony. You have to be able to say, okay, how do we shift and kind of move things around a little bit to make that happen? And that's kind of just, you have to do that in every market, not just today. It has to be your way of life.
Yep. Totally.
Yeah. And similarly to what you're talking about, direct TV going away, in a lot of ways, I think the hotel industry is getting crushed. And so a strategy that we're potentially going to deploy, we have some, so we started investing 6 years ago, Kartheek, but we have 6 or 7 single families that have come, full turn, so to speak, have a lot of equity, and we're starting to sell those off. So I think our next move may be to just start buying a property like vacation houses in high demand like destination locations, because it's very difficult to find apartments, and I'm just trying to find other ways to get into appreciating markets with steady cash flow. And this is sort of a move that we're looking to make. I don't know if you have any thoughts on it, but that's just kind of my next chess piece, so to speak, given the market conditions that we have.
It makes a ton of sense. I mean, from my perspective, energy prices are super high today, right? And I think they're going to stay high in at least the short term and the medium term. I mean, at the end of the day, we've underinvested in capex when it comes to the oil industry, right? And that's kind of catching up with us now. So with higher energy prices, that means that folks might fly less. Folks might drive a bit less, but I do think, to your point, regional travel is going to stay strong. So I could see folks, looking to opt to go to, a place like Virginia Beach or where you are, or the Outer Banks, which is pretty close by to you, versus say flying to Vegas, right? Yeah. And staying at a hotel in Vegas.
Kartheek, last question here. I like to end the show with this. What do you know now that you wish you did when you had first gotten started? Not just in real estate, but in your whole career. What do you know now that you wish you'd known when you first gotten started?
Yeah, I mean, it's to get started, right? So with real estate, I think I first started listening to podcasts back in 2016, but didn't do anything until 2018, right? And it was kind of, what's the term? Analysis by paralysis. And there are a million things you can do in real estate, right? You can buy single families, multifamilies, triple net deals, notes, a bunch of different things. And so, kind of getting going on one of these things, instead of kind of paralyzing yourself by looking at, different things. That's the way to go. And when you get going, that's when you start building momentum, and making progress in whatever it is that you are doing.
That's good. How to compound your life. Get started. That's it. How do you compound your life? You get started. You do it. You just do the thing. Oh, my Uncle Jonathan always says, momentum is a real thing. It's an actual real thing. It's not just an idea. It actually happens, and it actually affects the outcome. If you get started and you maintain that and build it and just keep growing it, it actually does affect your life. It affects your business.
Yeah. It's a real force of nature, in my opinion.
Kartheek, dude, you're the man. Thank you for sharing your story. Dude,
I agree. You're a great investor and a better man. What's not to do? Dude, thanks for coming on, man. It's good to see you, and hopefully we'll connect at an event here soon. I'd love to catch up and, I don't know, figure out how to do some business. That would be awesome.
I was going to say one more thing, Kartheek. How can we add value to you? Is there anything that you're working on right now that we can add value to you with, or anything that we can do to help you in your business?
No, I mean, I really appreciate coming on this podcast. I think it's good to connect with you guys, get a better sense of you, and you guys hopefully get a better sense of me. I mean, we've obviously met up before, Jonathan. We had dinner and drinks together several months back, but hope this was helpful for you guys getting to know me, and it was helpful for me to get to know you guys better.
Absolutely. Yeah, for sure. All right. Well, I'm going to take us out, guys. Thank you so much for watching. Thank you for listening. Kartheek, thank you for joining us and telling us your story. For everyone who's listening, get out there, compound your life, get started. If you're in your 20s, start now. And if you're in 30s, 40s, 50s, start now. I don't care where you are. Get started, compound your life. This is the Evergreen Real Estate Podcast. Thanks for listening. Hope you all enjoyed. Take care.